Well, I think what you're seeing with the latest moves, again, it's a situation where they're ramping up production. And they obviously have a demand issue, and therefore they're reducing prices here in the US. I mean, they were very strategic in the S and the XCO price reductions were now on there. They're going to be eligible for the some of the federal incentives. In a recent CNBC Closing Bell Overtime episode, former Ford CEO Mark Fields shared his thoughts about Tesla's stock slump and the auto industry at large. Their Field shed light on the current challenges faced by the automotive industry, particularly concerning escalating cost, dwindling demand, potential repercussions of a union strike. Fields speculated that Tesla's recent price reductions may stem from a slump in demand, possibly indicating an affordability crisis in the market for new vehicles. According to Fields, the average consumer must now earn a staggering six-figure income of over $100,000 to comfortably afford a brand new car. So clearly they have a demand issue as you go from kind of early adopters to mass adopters of electric vehicles in the US. And you're seeing their pricing reflect that. And I think that's what was reflected in their stock price today. Consequently, the industry has witnessed a gradual decline in vehicle prices, prompting an inventory adjustment to align with the evolving market dynamics. Nevertheless, the former Ford CEO thinks that Tesla has a unique knack of getting revenue out of rivals. When Tesla struck a deal with Detroit's Big Two, General Motors Corp. and Ford Motor Co., allowing their electric cars access to its charging infrastructure. Fields weighed in on the development and what it means for Tesla and the two legacy automakers. I took over. Overall, Morgan, what you're still seeing a lot of pent-up demand in the marketplace. I mean, with the supply chain issues over the last couple of years, inventories right now are still nowhere near where they usually are at this point in time of the year, although they're up 70% more or less from last year. And that's why you're seeing some of the automakers increase incentives. But I think to your point, when you look at what's happened with pricing, I mean, the average new car alone is of $760, which is up about 30 to 35% versus where it was back in 2020. And the same thing for used cars. So you have a situation in which affordability, literally you have to make over $100,000 a year just to afford a new car. And another CNBC interview, Field said at the decision by Ford and GM to align with their rival in the EV arena was a pragmatic move. The build out of the charging infrastructure is not keeping pace with the number of new EV products these companies are bringing to the marketplace and the ramping up of their production. He said what Ford and GM get out of this is not just an increased number of chargers, but the dependability of them. Field said, adding that the current combined charging system is not so dependable. He sees the partnership as all about the consumer experience. Fields also sheds insights into fears about whether Tesla CEO Elon Musk has made a deal with the devil, effectively advertising competitors. Products Tesla has a unique knack of getting revenue out of their competitors. Field said simply he referred to Tesla selling EV tax credits to other automakers that were not meeting their fuel economy requirements. Now the muscled company is doing the same with its charging business. So that's important for the automakers because, yes, they're giving some money to their competitor, but at the same time, they're thinking about how they're going to, turbocharge their own sales and also about repeat sales the next time the customer buys an EV and comes back into the marketplace. He said when asked about potential disgruntlement among Tesla users who may not like the loss of exclusivity and delusion of experiences. Field said the EV pioneer has to strike the right balance. Tesla can come up with some creative things like having charging stations at its locations just for Tesla cars to actually create those kinds of special clubs. The auto industry veteran said he also noted that the sharing of charging infrastructure was only at 12.0 of the locations. Tesla could have more as it has been swift in building charging infrastructure. He added Tesla also has data on where the prime locations are, and it can use that for fighting which charging areas can be made available to non-Tesla owners. Fields noted that Tesla has been building the charging infrastructure for over a decade, and the service has high customer satisfaction. In fact, he said Fields expressed his insights on the ongoing negotiations between major automakers and the United Auto Workers. We emphasize that labor costs constitute approximately 10% of the total vehicle expenses, making on a forthcoming union contract a critical turning point for industry. Giants, notably the UAO, has demanded a substantial 40 wage increase throughout the contract's duration, further intensifying the significance of the negotiations as the industry braces itself for these pivotal developments. The future of automotive manufacturing hangs in the balance in light of this. An expert said that Tesla could be a big winner in case of UAWS strikes. For context, the United Auto Workers strike against the big three automakers, Ford, General Motors, Stellantis continues to loom as the deadline draws closer in light of this Nathan Bomey, Axios business reporter and co-author of Axios Closer newsletter, and David Madland Center for American Progress senior fellow and American Worker Project senior advisor joined Yahoo Finance Live to discuss potential strike and its impact on the auto industry. Bomey said that there's a possibility of striking all three at the same time. And if that happens, we would see serious bottleneck in the auto industry. He also added that Tesla would be the winner. If there's a big strike, the company would also be the winner. If the automakers have to agree to huge pay increases, because of course Tesla is not unionized anyhow, going back to Ford's former CEO Mark Fields, he had previously shared that Tesla is still the benchmark for the electric vehicle market, and smaller players are at risk of failing or being swallowed up by larger peers. According to former Ford chief executive Mark Fields, he told CNBC's Squawk Box in an episode a few months back that some of the smaller companies like Lucid run the risk of being taken over by bigger companies. Among the growing pack of EV makers, I think every automaker still benchmarks Test as the leader at this point. Field said he noted revenue misses for both Lucid and Nikola Group as worrying signs those companies have also been plagued by persistent supply chain bottlenecks that have slowed production, and it's only going to get tougher for companies like Lucid and others that are pricing vehicles in a high-end price range where competition from big incumbent rivals like Mercedes and BMW is stiff. One thing is for sure, these companies are going to continue to need capital to grow their businesses. Field said some will succeed and some will have to be bought by some of the larger players. Meanwhile, Fields highlighted Tesla's ability to control vertical integration when producing its vehicles, which has allowed the company to be the master of their own destiny of the cost. When you combine that with their brand, which is held in high regard, they were a first mover. They continue to get a premium, Field said after Tesla's investor day early this year. Field shared his 2 cents. Tesla right now is one generation ahead of the other automakers. Field said, though, rivals like Ford and Hyundai are making a lot of progress. Tesla still has the leg up on the competition, and I think they demonstrated that further. Fields predicted that the EV industry will eventually have no one leader as the market continues to strengthen. There's going to be a number of winners and there's going to be a number of losers, because when you look at the adoption of EVs over time, I mean, this is a huge addressable market, he said, but for now, Tesla remains to be the EV leader. Why? Well, simply because as an EV car maker, Tesla has accelerated ahead of the bigger players due to their manufacturing techniques. It was not easy at first, but a struggle for mass production. Tesla had to face some manufacturing hell as they started to figure out how to build their cars at scale. Tesla's method seemed counterintuitive as an automaker. Instead of mass producing cars for affordability, they focused on quality and performance to drive demand. What is also keeping Tesla ahead of the curve is its focus on research and development. Is already well known that as some of the world's brightest engineers and scientists are working at Tesla. Tesla's contribution to R&D amounted to $1.5 billion in 2020 alone, according to a report. Tesla spends more on R&D than any other automaker. That amounts to $29.84 in R&D investment per vehicle. Subscribe for more.